Most traders are waiting for a single, violent event, the giant red candle that finally wipes out the herd and creates a bottom. But as this structure begins to fracture, the collapse is silent, occurring in slow motion rather than all at once. We are conditioned to expect a sudden reset because of how the 2017 and 2021 cycles ended. In those years, a sharp crash was the natural conclusion to widespread euphoria and a vertical climb in price. The 2025 peak followed a different pattern. Instead of a vertical blow-off top, Bitcoin reached its highest levels on declining volume and total apathy. Even as price pushed new highs, retail and social engagement stagnated. Speculative breadth was missing. Because the market never reached a point of collective mania, it lacks the energy to produce a rapid V-shaped capitulation. There is no bubble to pop, only an excess that must be slowly digested. This shift in market structure has ushered in a period of time-based capitulation. In this regime, the market unwinds its excess through months of sideways consolidation and intermittent shallow rallies. It is a process that exhausts participants through boredom and frustration rather than a sudden panic. To navigate this, we have to look at the specific path risk takes as it leaves the financial system. Traders waiting for a single day of volatility to signal a bottom are finding their capital slowly eroded. The current consolidation is mechanically removing players who lack the liquidity to wait out a year-long grind. This sequence is the risk cascade. Tightening liquidity moves through the market in 5 distinct stages, starting with the most speculative assets before reaching the core economy. Stage 1 occurs when social risk metrics collapse, retail engagement drops, and public interest in speculative assets fades. Stage 2 is the active weakening of altcoins. As liquidity tightens, capital moves up the quality ladder. Instead of rotating into smaller assets, money funnels back into Bitcoin. This consolidation into the largest asset explains why Bitcoin dominance climbs even when the broader crypto market feels stagnant. This early stage often traps altcoin investors who see Bitcoin's relative strength and assume a broad bull market is about to begin. Eventually, the drain moves beyond the crypto ecosystem. Stage 3 marks the point where risk begins to leave traditional equities. This is visible in the ratio between the S&P 500 and gold. When this line trends down, it shows that equities are losing value relative to defensive, real assets, a sign that investors are prioritizing capital preservation. Based on this weakening in equities against gold, the market is currently transitioning from Stage 3 into Stage 4. Stage 4 involves the tightening of financial conditions through broader macro pressures. Rising oil prices and a strengthening dollar act as a persistent drag on economic growth. The liquidity drain is no longer contained within speculative digital assets. It is now impacting the broader, real-world economy. During this slow-motion decline, the market frequently produces counter-trend rallies. These brief surges create a sense of false hope among retail traders. We recently saw this as Bitcoin rallied toward the 70K range. Price hit the 21-week EMA, a level that historically acts as a bear market resistance band, and immediately faced a rejection. While price was rallying, stablecoin dominance found support at its own bull market support band. This shows that capital is moving to the sidelines rather than entering the market to support a new leg up. This leads toward Stage 5, the labor market feedback loop. This final stage is characterized by a nonlinear acceleration in layoffs and a spike in unemployment. We aren't there yet. While there is softness in the job market, we are in a restrictive phase where the economy is digesting previous excesses. Without a definitive break in the labor market to reset the cycle, these rallies lack the structural support needed to sustain a new bull run. We are in a liquidity-constrained environment. In this regime, the aggressive buying strategies used in high-liquidity bull markets often lead to significant losses. The mechanical weight of the macro environment is currently trending downward. Buying every dip in the altcoin market ignores the reality of the risk cascade. Until we see emergency policy easing or a spike in unemployment that forces a shift in the cycle, the primary goal must be capital preservation. This requires strict risk management. Keeping trade size limited to 1 or 2% of your total capital ensures that you can survive the periods of high volatility. Success in this market is a matter of attrition.
surviving the risk cascade requires the discipline to protect your capital and allow the necessary time for the cycle to reset.